Hello everyone, my name is Mac, and in today's video, I'm bringing you a full free 2024 beginner course. Now, I get asked all the time if I could make some content for you beginner traders out there that are looking to trade. You see my videos, they probably sound super foreign to you if you don't have the basic understandings. And well, in this video, I'm going to be giving you 8 course topics, all for free, that I wish I had when I first started learning how to trade. Now, I just want to disclose, I will not be talking about key terms, so beginner terms. I will link babypips.com down there. That is where you can learn the absolute basics for free. So the terms and all that, I'm not going to cover that. I'm going to cover beginner topics that I think you all need to know in order to get to that advanced or intermediate level to become a better trader. So without further ado, let's jump into the first topic. So as you can see here, the topics that we are going to discuss in today's video are market structure, major pairs with the DXY confluence, ranging markets, trending markets, key levels, supply and demand, sessions, and intraday timeframes. Without further ado, let's jump in. All right, so topic number 1 is going to be market structure. So there are 2 types of structure when we're talking about the market. There is bullish structure and there is bearish structure. Bullish structure is when the market is going higher, producing higher highs and higher lows. And bearish structure is when the market is producing lower lows and lower highs. I will draw examples of those right now. So this is an example of bullish market structure. You can see we're creating higher highs, higher lows, higher highs, higher lows, and the market is trending upwards, right? So structure is going to be these levels here. This low, this high, this low, this high, this low, this high, and this low, this high, etc. You get the point. So structure is going to be this low and this high. So as long as we are seeing higher highs and higher lows, we want to be trading in that direction. So if we're looking to buy, we want to wait until the market comes back down into this region because we think the market is going to make a new higher high based off of the structure that we are being shown. For a market to switch structure, what has to happen is this low has to get broken. So once we come into an area like this, you will see a lower low and then a lower high. Then we can start to assume that the market is going to continue lower because we have these structure points that are being created. So now I'm just going to mark out the bear structure in red. Let me just do that right now. You can see we have the high. We invalidate this low. So we've had a break of structure. Let me just mark this out like such. And I'm going to mark this out as BOS. We're only looking for buys over here. And then once we see a structure shift like this, then we start to look for sells every time the market retraces back up into this region that caused the move down. So here's our bearish structure. Market structure is one of the most important parts in trading because as traders, we don't know where the market is going to go. We have clues, and the clues are the market structure. The structure is showing us where the market is currently going, where the momentum is, and where the trend is. Yes, you can look for counter trend trades. So for example, looking to short here, and short here, but you can see how short-lived those moves are. The real moves are when you are trading in the direction of the trend, when you are trading with bullish market structure for longs and bearish market structure for shorts. So let me show you some examples on the charts so I can get further into detail on this. So right here to the left, you can see we started to create bullish structure. The market was in a bullish trend. The market is continuing to make higher highs and higher lows, right? We then create this low that fails to create a new high, and then we break that low. So now we have had a market structure shift to the downside. I'm going to mark that out right here like so, and I will show you the difference in direction once we break those significant structure points. If I zoom in now and we're paying attention to the right here, you can see once we broke this low here, I'm just going to quickly change these. I'm going to quickly change this drawing to red so you have a better understanding of the structure. You can see we break this low. We then go and create bearish structure. Right? Notice how the market is continuing to make lower highs and lower lows because the structure has now flipped bearish. And the best opportunities come when you are trading in a line with that bearish trend according to the structure we are being shown. It is the best way for us as traders to anticipate where the market is heading next. Like you can see here, we are just continuously making lower highs and lower lows until the market switches direction. And when do we know the market has switched direction? when we break structure. Pay attention to this high right here. Once we break above this high and we've had that break of structure, then you can see the market has now flipped bullish. So EU is now bullish, and you will notice the market respects the higher highs and the higher lows, right? Right here, you can see the market is continuing higher, right? Continuing higher until once again, we break structure in the opposing direction. So here you can see we break this low. Let me just mark this out quickly, like so. Once we break this low right here, we are then bearish on EU, and you will see, let me just mark this like so. Notice how this high goes and creates this low. Then the same thing that I just previously showed, we are trading lower and lower and lower until we break structure once again. And now the market is bullish. Do you guys get the common theme here? We want to trade with what market structure is currently showing us. That gives us the best opportunity to be on the winning side. I'm just going to mark this out like so. Bullish structure is intact. And then now we will have to see if this low right here gets broken in the next coming days, coming weeks. Because as long as this low holds, then we will continue to make higher highs. But if this low breaks and then we come down lower, then we can anticipate something like this to form now. That is the market structure topic. I hope I covered it to the best of my abilities. Let's jump in to topic number 2. So as you can see here, we have EU, GU, USD CAD, AUD USD, USD JPY, and USD CHF. Now these are the 6 main Forex currency pairs that you want to be trading. The reason I love trading these pairs is because we have the US dollar to influence our bias. So you can probably see here, I have strong or weak dollar. So what that means is if I think DXY or I think US dollar is going to be strong, that means foreign currencies are going to be weak. So for example, strong USD, strong dollar means EU, AU, and GU are going to short. So it means they are going to be bearish. We are going to see bearish market structure. If US dollar is going to be strong, then that means USD CAD, USD JPY, and USD CHF are going to be bullish. We're going to see bullish market structure, right? Vice versa. If dollar is going to be weak, we are going to see the foreigns rise and we're going to see the US dollar pairs sink, right? So using DXY, it's called DXY on the chart. Using DXY gives me an extra confluence when looking at the markets. So every single morning when I get on, I look at DXY first, because if I think DXY is going to be strong, then I know my bias for the foreign pairs, right? If I think it's going to be weak, I know my bias for the foreign pairs. So I pay attention to it on a high time frame basis. For example, when we took this low out here and we had this bullish move, I was only looking for shorts on foreign pairs. Once we took out this liquidity pool up here, then I was looking for longs on foreign pairs. It keeps it extremely simple. And a lot of people don't use DXY as a confluence. I find when you just focus on the currency pair by itself, you are missing half of it, because DXY is what moves the markets. It's what moves the stock market. It's what moves indices. It moves gold. It moves all the major currency pairs. So if you're not paying attention to the main driver of price, then you're only seeing half of the coin. You're only seeing 50% of it. When you're able to use them both in confluence, you're able to have the most amount of probabilities in your favor, in my opinion. This works extremely well for me, and it's something I wish I knew at the beginning part of my journey. Once I knew the terms, once I started to look at the charts after learning all the basic terms, this is something I wish I knew when I started, because it would have helped me a ton. I would have been on the right side of the market way more than I was, and it's a big confluence. It's a big reason why I'm a successful trader now, is because I started implementing DXY into it. So these are the currency pairs that I suggest you trade. They are great in London session. They are great in New York session as well. And then using DXY as a confluence to only increase your odds and probabilities on your trade setup. Next up, we have ranging markets. So what is a ranging market? A ranging market is when the market is consolidated. So the market is being held in one place, and what it is doing, it's accumulating orders, and it's also stacking liquidity on both sides for when the market wants to move, it's got the amount of liquidity it needs to move in that favorite direction. The next video you are about to see is touching on those trending markets, but we don't want to trade this. This is consolidation, and this is where a lot of traders lose. As day traders, people feel the need to trade every single day. I'm a day trader and I don't trade every day. The trick is you want to trade on the highest probable days. And those high probable days are when the market is trending. A lot of the time when the market is consolidating like this, it's because of one of two things. One, there's a news event that day or there's a huge news event that week. So the market will wait until that news event and build a ton of liquidity on both sides, slaughtering all these traders that look to get involved right here. The second is after a massive move has happened. So once a big bullish move or a big bearish move has happened, the market needs to accumulate or distribute. So we're going to see something like this at the end of a big buy move, and then we're going to see something like this before the beginning of a sell move. This is something that happens time and time again, and we can go look at it on the charts now. Here is a perfect example from price action this week on USD CHF. We had NFP this week, so we had a big news event and the market was waiting all week for that news event. You can see all these traders that got caught in here. Once news was released, we took the top and then we went and took the bottom of the range. So this is a low probable condition. Let's take a look at another example. Here is another perfect example of a low probable condition and a ranging market. Right here on Euro USD from July, you can see that the market was held in this consolidation. These are all extremely low probable conditions. You can see that once the high is swept, the low is swept, the high is swept, the low is swept. It is being held in this condensed range. Once we take the top of the range, we then go and look for the opposing liquidity, which is the bottom in the range. See how different this looks than the trending market? Pay attention to this bearish structure here that I showed previously and how clean that looks versus how bad this looks versus how bad this looks right here, right? And how bad this right here looks. You don't want to be trading this. We want to be trading when the market breaks out and gives us that clean price action. So do your best to stay away from ranging markets. If you only trade a few pairs and they're ranging, you can either sit out and wait for them to not range, or you can take a look at another pair on the majors list here and see if there are any other opportunities. Let's jump into trending markets. So what are trending markets? Trending markets are when the market is continuously moving in one direction. So either bullish or bearish, like I have previously shown earlier in the course. So for example, a trending bullish market would be this. The market is continuing to make higher highs and higher lows. This is a trending market. Then once we break the low and we start to see lower highs and lower lows, this is a trending market. Like I talked about in the previous course section, we want to be trading this beautiful price action. We do not want to be trading markets that are ranging or consolidating. So you can see the difference right here in the drawing. I know I just showed it previously, but look at how much easier this is to analyze. When we think the market is going to be moving up, we want to look to enter when the market is making that higher low, right? When we want to sell, we want to be looking to enter when the market is making that lower high, right? Just like this. When we're trading this range environment, this is when you are going to lose most of your trades. I myself don't look to get involved at all. I touched on in the previous section why the market ranges, and the best way to trade them is to simply sit out of them and wait for the market to go for one side. Because once the market takes one side, like you have just previously seen in the section before, it'll usually go and look for the other side. So it's a great indicator of when to trade and when not to trade. Next, we're going to be covering key levels and psychological numbers, or psych numbers, whole numbers, big figures, whatever you want to call them. So these are the figures on the chart where institutions are going to be looking to put their orders. And you can pay attention to how key these areas are. A lot of people call them support and resistance levels. It honestly doesn't matter, but these are numbers you have to pay attention to. So the numbers you have to pay attention to are like 00 or 50 or 25, right? And you have to think about it. When institutions are exchanging a currency, they're not going to say, I want 1.08 21496. No, they're going to say, I want 1.08, right? For example, right here, look at the right, 1.08, 1.08000. This is a big figure. Another big figure is 1.08250. Then we have 1.08 500. Then we have 1.08 750, and then we simply have 1.09. So let's take a look on the higher time frame, and I'll mark these numbers out for you and see how well they're respected. So what I like to do to mark them on is I like to use the horizontal ray tool over here, and then you can line it up as best as you can. So I'm going to go 1.06, for example. And if you get it over, all you have to do is click it like so, go to coordinates, and you can actually bring it down to the perfect number, right? So you can see here, very key level if we look to the left, 1.06, right? Because it's a big institutional number, it's a big figure number. Look at how well they are respected when it breaks above it or when it's below it. There's usually an accumulation around that region. And the same thing goes for the other numbers, but the ones I'm going to pay attention to the most right now are the whole numbers. So the 1.06, just because you can have a lot of numbers on your charts, let's just keep it simple and do it this way. I'm going to mark out the 1.07 right here. And again, I'm going to do 1.08, and then we'll do 1.09, and we'll just leave it at that. You guys get it. So again, coordinates, we're going to bring it down lower and make it as accurate as it can be. Looking at this price action in front of you, you guys can see how key these levels are. And when we're in these areas, we want to be using it as a confluence. It's an added confluence, right? If we think the market is going to be bearish, then we want to look for sells in these regions. We also want to see how the market is reacting out of these areas. Is it holding? Like for example, if we're looking at 1.07 over in this region, look at where all the bodies of these candles are closing, all above 1.07. So we can assume the market wants to head higher because it's failing to break below 1.07. Same thing goes for 1.09 over here. Look at how choppy this is, right? Below the area. If we look to the left, it's a very key area, and the market either holds as resistance or it breaks above and has an explosion to the upside, right? We break above it with an explosion to the upside, come back, retest it, continue up higher. Here we retest it, we sell off. Here we explode above it, right? Here we break below and retest it and use it as support. They're very, very key levels to use, and I use them in my trading all the time. You don't have to do the smaller ones like I marked out, but you should pay attention to them when you're looking at price action, mainly on the intraday timeframes. But if you're marking these out, these should be on the high time frame only. If we take a look at USD CAD, I'm going to mark them out for you as well, just so you can see how important and how well they are respected. So right here, we got 1.32. I'm going to mark this out right now. Then I'm going to mark out 1.35. You guys get the gist of it, but I just want to make sure and ingrain it in your head the best I can. 1.37, and then we can do 1.39. Okay? Sometimes they are hit to the literal pip and respected. Like if we're looking at 1.39, look at this. Respected this to the T. We sell off. We fail to break it again. We sell off. Here we fail to break it again and we sell off. Then we use 1.37 as support and continue lower. We bounce off of 1.35. Once you have these levels marked out, it makes trading a lot easier because you're thinking like the institutions are, right? Remember what I said, when institutions are converting their currency, they don't want 1.3246, blah, 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 blah. They're looking for the big whole numbers, right? Look at how well 32 was respected right here. As support, as resistance, accumulation below it, an explosion above. It's just simple. And when done on the higher time frame, this is going to help your trading huge. When I was learning as a beginner, this isn't something I learned whatsoever, and it held me back. And once I added it as a confluence, I felt I was on the right side of the market way more times than I wasn't. So hopefully using this will help you become a better trader. And let's jump into the next topic. Next, we're going to be talking about supply and demand. Now, this is something I use in my trading every single day. It's something I wish I learned as a beginner trader right away. I didn't learn about supply and demand until years into my trading journey, and it's something that has taken my trading to the next level. So supply is going to be when we see some sort of range like this that sends price down. This is going to be supply. We can expect the market to retrace back into the supply to then continue lower. It's a very key area that when aligned with the psychological numbers and support, resistance, etc., it can be a very key area to get involved, right? And if we're trending bearish, a lot of the time the market will come back up into the supply to then continue lower. Demand is the opposite. So supply is for sells at the key areas and demand is for buys, right? Just like in this area, just like in this example, we have some sort of consolidation that creates like an order block or demand level, right? Then the market pushes away from it. And then a lot of the time we will see the market come back down and react from that demand level. These are areas we want to be looking to enter trades at major supply and demand levels. This took my trading to the next level, and I can't wait to show you some in-chart examples now. So let's do that. Let's take a look at GBP USD, and we'll go over supply levels, and then we'll go over demand levels, okay? So looking at this price action right here, based on the drawing that I had just shown you, where do you think the supply levels are going to be? I'll give you 1 second. Where do you think the supply is? All right, hopefully you pause this video. The supply levels are going to be the significant area that goes and creates the move to the downside. So for example, this region here is going to be a supply level because you can see we had the range and then it pushed price to the downside, breaking this structure point. The market then retraced back up into this supply level that caused the move to go down lower. And then this is where we want to look for short opportunities. And you can see the market continues lower from that supply area. Now let's continue the trend and see where the next supply level would be. Again, consolidation here. That sent price down lower. We're going to mark this out, and this is going to be our supply level that we're going to be waiting to short from. These areas always get respected. Now, how long they get respected for is another thing, but usually we will see some sort of reaction out of this area to either continue lower, or we'll get a temporary reaction regardless, and then it'll continue higher. But these are the areas we want to be looking for price to sell from, right? If I'm paying attention to this price action right here, this area was responsible for the move down. We mark this out, and you can draw it across and see how well respected this supply level was. Let's continue lower and just look at it over and over and over again to train your eyes. Here, we have a supply level. If I draw this across, the market sends lower. Here we have another one. Drag this across. You can see the market sells off from. And yeah, it's just simply following structure and combining it with these major supply levels that is going to help you get on the right side of the market. Now let's take a look at USD CAD for some demand levels, okay? So polar opposite of the supply, we're going to be looking for the areas that have caused the big move, and we're going to mark that out as our demand level. For example, we have this range over here. We're going to draw that across, and this is going to be our demand level because you can see here, we actually broke to the upside, breaking structure, breaking above the supply, and the move came from this demand level down here. Then look what happens. The market retraces back into that demand level, and then we have a big move to the upside again. Then all we're paying attention to is those demand levels that caused a significant move to the upside, breaking structure. For example, on the daily right here, you can see we have this demand level here that broke structure. We broke above this high. So this is going to be our key demand level, right? Then the market broke structure again. So this now is going to be our key demand level. And you can see that the demand is giving us the best opportunity to enter, right? Because this demand level was significant enough to break structure to the upside. So we want to be entering in those significant areas that broke structure. Now it's all about looking for those recent areas to look for long opportunities, right? So for example, here we have another one that we had this demand zone. We break structure to the upside again, and you can see how key these areas are, right? Here we go, break structure to the upside. We respect it once again. Now, this is like clockwork, right? And a lot of the times, once these key demand levels are broken, we want to look for shorts. So for example, when this demand level is broken, we want to look for shorts out of the area that broke that demand level. That usually gives us an extra confluence when looking for a reversal or a break in market structure. When these key areas are broken, the area that breaks them is our new key area. Here we have another example on GU. This area right here, this range, you can see was responsible for this big move to the upside, and it held price. So demand was respected in this region. Now we're looking for the next obvious level that breaks structure to the upside, this demand right here. Consolidation, break structure to the upside, we come back into this level, and then we can look to take longs. You'll notice that when the bullish trend is continuing, demand is kept intact. When the bearish trend is continuing, supply is kept intact. So it's just about knowing what market environment we are in and entering in those levels, right? Like I brought to your attention earlier, GU trending bearish, the supply will hold. GU trending bullish, the demand will hold, right? And here we have a nice demand level right here. If I drag that across, was respected very nicely, right? And now when we're looking at GU, this could be a region right here that we're paying attention to potentially look for longs, right? So it's just about using the high time frame demand levels to our advantage to look for the best opportunities, and vice versa, using the high time frame supply levels to look for entries to give us the best opportunity. So let's jump in to the next topic. Let's talk about sessions. So in Forex, there are 3 sessions that we can trade. There's Asia session, London session, and New York session. Now you may notice I have a star beside London session and New York session. That is because those are the 2 most volatile sessions. Those are the best sessions we want to be trading as Forex traders. Yes, the market moves in Asia, but it's not as volatile because there isn't as much liquidity involved. The sweet spot for New York and London is when there is the overlap. So London session merges into New York session for about 3 hours. That is the best session time. Now what I'm going to do is show you the session indicator I use to make sure I am on top of everything. Okay, so it's called Asian session range over here. Sorry, it's a little bit of a tongue twister. And I'm just going to click my settings so you guys can look through and pause the video and copy them. And I'll show you exactly what it looks like. You can see I'm just going to scroll down quickly and you guys can pause this. All right, pause it whenever. Now let's look at style. Awkward silence. Awkward silence. So that's the style. And then visibility, I usually have it just on the minutes. So let's take a look at what this looks like. So right here, if you like it clean like I do, then you're gonna love this. Asia is blue, so this is the Asia session. London session is a green color, and then New York session is a purple color. So right here, you can see the difference in session volatility, right? Look at Asia. Asia usually ranges. London is nice, and then New York is nice. And it's pretty much like clockwork, right? Look at the difference. Asia, London, New York session, right? And based on the session, you want to be trading a currency pair that best represents that session. So what do I mean by that? When you're trading London session, then you can trade GU, EU. Those are the 2 best pairs that I personally would trade during London session. Trading New York session, you can trade EU, GU, USD CAD, AU, USD JPY, USD CHF. Asia session, I would suggest trading USD JPY or AUD USD because technically Aussie is in the Asia session. You'll notice that it moves very nicely during that session, but what you don't want to do is trade your pair in the wrong session because you simply won't find the moves you want to be looking for. You could get caught in consolidation or a ranging environment like I talked about earlier in the video. So yeah, there are 3 sessions and the session times are going to be different for everybody. I'm not going to give you the session times because it's going to be different for everyone watching this video. So instead, put this session indicator on and you will automatically get the sessions based on the time zone that your trading view is set to down here. So for example, mine is at New York time. So then my Asia session is according to my New York time, right? So it's going to be different for everyone. My London session is based on New York time, vice versa. So yeah, I'm not going to say New York session starts at this time, London session starts at this time, because it's going to be different for everyone watching this video. Make sure you go to this free indicator and it's going to give you the session times, or you can quickly Google what time is Asia session, what time is London session based on your time zone, and that will help as well. Lastly, we're going to be talking about intraday timeframes and top-down analysis. Now, I have them together because they're exactly the same thing. I wrote intraday timeframes instead of top-down analysis because I'm also going to share what time frame I think you should sit on while you're waiting for the market to develop in your session, whatever that session is, Asia, London, whatever, New York. So without further ado, let's jump into what a top-down analysis is. So a top-down analysis is something you should do every single day when you get on in the morning. A lot of traders jump on and the first thing they do is go to the lower time frames, the 1 minute, the 5 minute, the 15, without any high time frame context or direction to follow, right? So what I do every single day when I get on is I look at the high time frame all the way down to the lower time frame. First, you want to start off on the weekly and see where the market is on the weekly time frame. Are we at any key levels on the weekly? Have we taken out any liquidity areas on the weekly? This is all stuff you need to pay attention to. Now, you don't have to dive too deep into it, but you just have to be aware of where we are. Then you want to jump down to the daily time frame and see, okay, where are we on the daily? Are we bullish? Are we bearish? Did we have a rejection candle? Did we have a strong daily close, whether that be bullish or bearish? That's another thing you want to keep in mind because we want to be trading in line with what the daily and the high time frame is saying. Then once you have your daily markup done, you can jump down to the 4-hour time frame. Now, the 4-hour time frame is one of my favorite time frames for intraday direction because it gives us a high time frame approach, but at the same time, it's a nice day trading direction bias to follow, right? So if the 4 hours bullish, then obviously we want to look for longs. If the 4 hours bearish, then obviously we want to look for shorts. You can trade opposite of that bias, but you have to remember that you are trading counter trend and it's a lower probable trade. Then once you have the 4-hour down, you can then check the 1 hour and see what the 1 hour is doing. So if the 4 hours bearish, the 1 hour is bearish, that's when you are adding confluences that you want to look for shorts, right? And paying attention to these time frames and using them all together to paint one picture is how you are going to be on the right side of the market. After you do your hourly analysis, then you jump to the 15-minute, and that is the time frame I love to sit at, and I think you should too, to watch price develop in your session. Because if you're sitting on the lower time frame, you're sitting on the M1, you're going to think you're seeing breaks of structure here, you're going to think you're seeing all this and that, and it's happening super fast paced. It's going to trick you into getting into positions that you don't want to get in. By sitting on the 15-minute time frame and sitting on the hourly, etc., you're able to wait for price to get to your area, your supply, your demand level, and then you can break to the lower time frames like the 5-minute, the 15, and look for your entries. But your analysis should always be from the top all the way down. I've been in a point in my trading, guys, where I would get on and look at the seconds time frame right away, and try and base a trade ID off of that. And it's just absolutely hilarious, and it's awesome to look back on. And that's why I was excited to make this free beginner course for you guys, because I'm giving you guys content that I wish I had when I was learning. And I hope you were able to take some value away from this. If the video was confusing, maybe watch it again, maybe watch it maybe once or twice, 3 times, 4 times, it's up to you. But the topics in this video that I covered are going to make you guys much better traders. If you enjoyed the free content that I posted here and you've watched this beginner course and you want to see how I trade, then you can check out our advanced mentorship in the link in the description. You can see 16 A+ detailed course videos, over 97 video case studies. We do Sunday breakdowns for the week ahead. We do daily markups every single day for New York session, what we want to see. There's trading resources. You have an amazing Discord community holding your hand along the way to success. And it's just an amazing thing. So if you watch this free content, you took some value away from it and you're interested, then just check out the link in the description, check out the website, and maybe it's something you want to do. If not, you can continue to watch these free videos. All I ask though is you drop a like, comment, and subscribe. That's the only thing. So yeah, I appreciate you all so much. And what do I say at the end of every single video? Let's be 1% better every single day. I appreciate you all, and I'll see you in the next one.